Chapter 16 deals with bad debts. When a company allows customers to purchase items on account, sometimes the company never collects what's owed to them from those credit customers. We call those accounts receivables that we cannot collect uncollectible or bad debt. There are two methods to account for bad debt. One is the allowance method, and the other is the direct write-off method. Under the allowance method, bad debt for the year is estimated with an adjusting entry at year end. If you think about it, not every customer with outstanding balances in accounts receivable at the end of the year is going to be able to pay. So the company estimates, based on past experience, how much of its sales or how much of its accounts receivables will become bad debt. That way, the bad debt is recorded in the same year that the sale occurred and therefore follows the matching principle. There are two ways to estimate the bad debt under the allowance method. One way is to base the estimate for the adjusting entry on the percentage of credit sales the company had for the year. This is called the sales method. The other method is based on the percentage of receivables remaining at the end of the year. This is called the receivables method. The other method used to account for bad debt is the direct write-off method. This method is easier to apply, but it does not follow the matching principle. Under this method, a company simply writes off bad debt when it becomes clear that the customer will not or cannot pay. So let's go over to CNOW and actually apply these methods. And we're going to start with exercise 12 or assignment 12, exercise 16.2. We have Rosson's Racers. They have credit sales for the year of $280,000, and they estimate that 3% of its credit sales will be uncollectible. Record the end of period adjusting entry on December 31st. Since we're estimating our bad debt at year end, we know that we're working with the allowance method, and since we're basing our estimate on the amount of credit sales, we know we're dealing with the sales method. Okay, so in the first one, the allowance for doubtful accounts has a credit balance of $570. Now, under the sales method, it doesn't matter what the existing balance is in the allowance for doubtful accounts. We simply calculate our estimate for the year and then enter it into our adjusting journal entry. So if we take $280,000 in credit sales and multiply that times 3%, we'll get $8,400 as our estimate. So we come over and debit bad debt expense for $8,400, and we credit the allowance for doubtful accounts for $8,400. And then under situation 2, we have a debit balance in the allowance for doubtful accounts of $360. Well, once again, since we're dealing with the sales method, it doesn't matter what the balance is in the allowance for doubtful accounts. We just enter our adjustment. So 280 at 3% is $8,400, so it's the same exact entry as before. And we'll see in the next problem that with the receivables method, it's a little bit different. This balance becomes more important. We're working on number 13, or exercise 16-3 in CNOW. And we have a company who estimates the amount of uncollectible accounts using the percentage of receivables method. So the company has aged its accounts receivable, and it's estimated that $4,500 will not be collected. They need us to record the year-end adjusting entry in general journal form, and we're going to base our entry on the following assumptions. Under number 1, the assumption is the allowance for doubtful accounts has a credit balance of $710. Now, if you're using the percentage of receivables method, you want your ending balance in your allowance for doubtful accounts to be the amount of your estimate. So our estimate is $4,500, and we need that to be over on the credit side because the allowance for doubtful accounts has a normal credit balance. It's contra to accounts receivable. So accounts receivable has a debit, and the allowance for doubtful accounts should have a credit. If it already has $710 in the account on the credit side, and we need it to have $4,500, we need to make our adjustment for $3,790. So we are going to debit bad debt expense for $3,790, and then credit the allowance for doubtful accounts for $3,790. So our bad debt expense is going to go up by $3,790, and our allowance for doubtful accounts is also going to go up $3,790. And if you add the $710 that's already there, then we know that we'll have a $4,500 balance like we estimated. Okay, now let's look at the next entry using the assumption that the allowance for doubtful accounts has a debit balance. So if you're working with the receivables method, it's critical that you look to see what kind of balance is existing in the account at the time of your adjustment. Okay, so since this is a debit balance, we have to get it to be a $4,500 credit balance. And the way we would have to do that would be to take the $4,500 estimate, that's what we want it to be, and then we have to add the $305. So in number 1, remember, it had a credit balance, so to get it to $4,500, we subtracted the two numbers to find the difference. But if your allowance for doubtful account has a debit balance, we have to make sure it has $4,500 as a credit balance. So we have to overcome the $305 debit plus add $4,500 to get it to the credit side. So we need to debit bad debt expense and credit allowance for doubtful accounts for $4,805. So now let's move on to 16.4, or number 14. Okay. All right, in this one we are going to write off the accounts that we know we are not going to collect. Okay, so in 16.3, or number 13, we were estimating the accounts that we would not collect. In this exercise, we are actually going to write off those customers. So we can't carry a customer in accounts receivable if we know that they're not going to pay, or we would just have that customer in accounts receivable forever. But when we are notified that that customer will not pay or cannot pay, that is when we write them off. And so when you see write off, remember that they're coming out of accounts receivable. So on July 7th, we wrote off $5,350 owed by Randy Dalzell, who has no assets. So if we are writing them out of accounts receivable, then we need to credit accounts receivable to take them out of our accounts receivable balance. Now the debit really depends on the method that you're using. So since we're using the allowance method, we're going to debit the allowance for doubtful accounts. So basically we're just reducing the allowance for doubtful accounts because we already recorded bad debt at the end of the year in our adjusting entry. Okay, on August 12th, we wrote off $28.70 owed by Jason Flint. Same entry, debit accounts receivable to take him out of accounts receivable and debit the allowance for doubtful accounts. Okay, on September 27th, we reinstated the account of Randy Dalzell, which had been written off July 7th, and received $53.50 cash in full settlement. So on occasion, we'll have a credit customer who comes back and pays, or maybe we might have received a little bit from the bankruptcy. So the way that we reinstate the account is we simply reverse the entry where we wrote him off. So we're going to debit his account again and then credit the allowance for doubtful accounts for the amount that he paid us, and he paid us $53.50. So now that his account is back on the books, we're going to collect the cash. So debit cash and credit accounts receivable. Now let's look at assignment 15 or exercise 16.5, and we'll be able to see the percentage of sales and the percentage of receivables methods side by side. So hopefully you'll be able to figure out the difference between those two methods once we complete this exercise. So we've got Glenn's Nursery Supplies with a debit balance in accounts receivable of $390,000. Then his credit sales were $2,800,000. So we are going to be recording the end of period adjusting entry under both the percentage of sales and the percentage of receivables methods. Okay, so the first one applies the percentage of sales method. His allowance for doubtful accounts has a balance of $1,760. So remember, under percentage of sales, that balance does not matter. So all we're going to do is enter our estimate into our adjusting entry. So it says that they estimate 1% of credit sales. If we go back up here, we'll see that credit sales are $2,800,000. So 1% of that is $28,000. So we're going to ignore any existing balance in the allowance for doubtful accounts, and we're just going to enter our adjusting entry. Remember that adjustment, no matter whether it's the sales method or the receivables method, is debit bad debt expense, credit allowance for doubtful accounts. Okay, and then in B, the percentage of receivables method is used. They've analyzed the accounts receivable, and the estimate is $30,330. So if you see in your problem that they've aged the accounts receivable, then that means you're using the receivables method, and in this case they've already gone through that process for us, and the estimate is $30,330. Now this is the receivables method, so the allowance for doubtful accounts balance comes into play. Okay, so we need the allowance for doubtful accounts to have a balance of $30,330. If we already have $1,760 in the account, then we're going to take $30,330 and subtract the credit of $1,760 to get $28,570. So that will be our adjusting entry. So this adjustment will bring the allowance for doubtful accounts balance up to $30,330. So same debit and same credit. Okay, now let's move on to number 2. In this case, the allowance for doubtful accounts has a debit balance of $1,900. So in A, we've got the percentage of sales method, which means we don't even have to worry about this balance. That bad debt is estimated to be 0.75%. So there are a couple of ways you can calculate that, but the easiest way to me is to take 1% of the credit sales $2,008,000, which would give us $28,000, and then take 3/4 of that. So you can say 28,000 times 3 divided by 4, or you can just say 28,000 times 75%, which is the same as 3/4. Okay, so that answer comes up to be 21,000. So once again, since we're using the sales method, we're ignoring any balance in the allowance for doubtful accounts. Okay, in B, we're with the percentage of receivables method again. So they have analyzed the accounts receivable, they've aged their accounts receivable, and come up with an estimate of $29,890. Okay, our allowance for doubtful account comes into play, and it has a debit balance of $1,900. So we need to get this balance over to the credit side and add $29,890 to it. So $29,890 plus the $1,900 comes up to $31,790. Okay, and we're going to debit bad debt expense and credit allowance for doubtful accounts. So we have to actually make the journal entry more than what our estimate is to overcome the debit balance that already exists in the allowance account. Okay, so what we have to do is, when you're working with the allowance method, look to see which method you're working with. Is it the sales method or the receivables method? If it's the sales method, ignore any existing balance in the allowance for doubtful accounts. If it's the receivables method, you have to recognize the balance that's already there. If it is a credit, you subtract it from your estimate to get your adjusting entry. If it is a debit, you're going to add it to your estimate to get your adjusting entry. Now we're going to move from the allowance method over to the direct write-off method. Okay, this is assignment 16, exercise 6. In this problem, Maria Rivera owns Rivera Pharmacy and uses the direct write-off method in accounting for uncollectible accounts. So in the direct write-off method, when an account becomes uncollectible, we just write it off. There is no adjusting entry at the end of the period, and the allowance for doubtful accounts does not exist. Okay, so on July 20th, we wrote off $23.25 owed by Joe Beluca, who has no assets. So since this is direct write-off, we go directly to bad debt expense, and then we just simply write off Joe's account by crediting it. Okay, so his balance was $23.25. On October 15th, we wrote off $16.75 owed by Alice Rose, who declared bankruptcy. Okay, so once again, debit bad debt expense and credit Alice's account. Now let's go over to number 17 and see what happens when we collect on an account that's been written off. Okay, so Cosmo's Music Store uses the direct write-off method in accounting for uncollectible accounts. On May 8th, we wrote off $17.45 owed by Vicki Lawrence, who has no assets. Okay, so we go directly to bad debt expense and then take Vicki's account out of accounts receivable. On July 15th, we wrote off $1,300 owed by Dan Utter, who has made no payments in more than a year. So we go straight to bad debt expense and then remove Utter's account. Okay, September 2nd, we reinstated the account of Vicki Lawrence, which had been written off on May 8th, and received $17.45 cash in full settlement. So notice that Vicki paid her balance within the same year. So we have a two-step process, and it's real similar to what we did with the allowance method. You reinstate the account and record the collection. So we're going to put Vicki back on the books by debiting her accounts receivable and crediting where we wrote her off with the bad debt expense. In other words, we just reversed the entry where we wrote her off. And then we're going to enter the amount here, and in the next step we're going to collect the cash. So here's the cash debit where she paid us, and now we're going to credit her accounts receivable that we just reinstated above. Okay, now in the next year we reinstated the account of Dan Utter, which had been written off in the previous year, and received $1,300 in cash in full settlement. So the fact that he paid his account off in the following year makes a big difference, because remember, the bad debt expense account where we originally wrote him off got closed out at year end. So his bad debt expense is no longer sitting on the books. So in that case, when we collect on an account that was written off in a previous year, we debit accounts receivable Utter to put his account back on the books, but there is no bad debt expense to credit, so we credit uncollectible accounts recovered. Now we're going to simply record the cash collection like we did in the other transaction. Whoops, let's put the amount in. And then remove Dan's account from the books.